I have a dream, that's all I need. I'll make it happen with some work and belief. Know what I want, so I'll take it on. I've made mistakes, but mistakes make you strong.
Hi, I'm JB. This video is part 2, or maybe it actually should have been part 1, as I will go through the metrics I look at to determine if I want to invest in a company or not, or at least these metrics are a big part of it. If you haven't seen my video part 1, I have a link in the description and a link in the card in the corner. So maybe you should take a look at that. So, quick recap. We have found a company we possibly would like to invest in. Now we need to figure out, is this a good, strong company that will return the required return? And if that's the case, what's the fair price for a part of that company? Well, actually, those were the questions I asked myself when I made this valuation method. It's fairly simple and easy to understand, and all the data can be either calculated using this sheet or found on several great websites like Macro Trends, Morningstar, Alpha Query, Guru Focus, or the likes of those. Unfortunately, some of those they require a subscription, but hey, maybe it'll be worth it. But just remember, there is great value to be found in digging around in the company's financials, and you get to understand why a metric that could look good on the paper really isn't that, and vice versa. So by finding the data yourself and putting it all together, you gain a lot more knowledge. I know it takes time, but trust me, it'll be worth it. For instance, Guru Focus has a target price for Intel at around $32, and that might actually be a good price, maybe in 2025, 2026, but right now, I believe it's a bad price. And you will also become more suspicious of other people's price targets and the metrics in themselves when you have plowed through the company's financials yourself. Well, we're basically looking for 4 things when looking at the financials. We're looking for revenue and growth. We're looking for profit and growth. Is it a growing business, and is it growing at the desired rate? We look at the free cash flow, how much we expect to get in return. Remember, we own a part of the company now. Debt. Are we growing organically, or are we just taking on more debt? Not all debt is bad, but in dire times like a recession, it'll be hard to take on more debt, and it will be hard to pay off existing debt, as interest rates usually go very high. So, we need to have a manageable debt load. As I said in part 1, I also look at if the company does something, let's call it shady, in the financials. Something I don't like, something I don't find attractive. And it's usually explained in a small print in the 10K filing. Take Intel, for instance. They mentioned that they extend the life of production facilities. What? In itself, that's not crazy. But the way Intel does it is rather questionable. Here's the text from their 10K filing. Effective January 2023, Intel increased the estimated useful life of certain production machinery and equipment from 5 years to 8 years. When compared to the estimated useful life in place as of the end of 2022, Intel expects total depreciation expense in 2023 to reduce by roughly 4.2 billion. Giving us approximately 2.6 billion increase in gross profit. So by squeezing extra 60% out of existing machinery, they theoretically got a 4.2 better financial outlook? But wait a minute. In reality, those machines will probably break down more, and as the chip business is relying on getting better and better equipment, I would argue this is not good at all. And a tricky way to cook the books a little maybe, but hey, it's just something I look into.
The point is, you gotta squeeze every penny. Come on, let me hear you. Squeeze every penny.
Penny! Squeeze every penny!
I'm squeezing it. Hey, I squeezed so hard it went into my hand.
Oh, Homer, not again.
Well, back to our metrics. What do I look at and what do they mean? I have compiled my Excel sheet as I talked about, and it's fairly easy when I found all the financial data. Just plug it in and the sheet spits out the data it's supposed to. At the top of my sheet, there's just a quick overview. There's the company name, ticker symbol, number of shares outstanding, and market cap. Market cap is just the current share price times outstanding shares and doesn't really give us any further information. Some people use the market cap to value a company, and I cannot see why that's helpful in any way, but hey, that's how usually analysts talk about it. This is a $1 trillion company. Who cares? I care if they make money. Then we have the current share price. Then I have the 52-week high share price and the 52-week low. That's good for judging where we are and how it's been going, if there's been volatility or something else is going on. Then we have the current share price, which is just what people are willing to pay right now for a piece of the company. Analysts and mainstream finance media always look at the share price and how much a price has changed. And that's really stupid. Like when a stock price is up 50% at a given moment, and not mentioning that it's still 20% below the 52-week low. And that doesn't even matter either. The only thing that matters is what is the company worth based on its earnings and growth, not whatever people want to pay for it at this point in time. Whatever the price might be at a given moment is just an opportunity to either buy or sell.
I would not sell Denny's. Call me a buy of that chain. That chain's move is in its infancy.
Well, next line is beta. Beta is a measure of a stock's volatility in relation to the overall market. So the S&P 500 has a beta of 1, and the stock's beta value shows it how much it deviates from the market. A stock that swings more than the market over time has a beta above 1. If a stock moves less than the market, the beta is less than 1. High beta stocks are riskier but have a higher potential of returns. Low beta stocks pose less risk but also have usually lower returns. Intel has a beta of 0.87, or at least it had when I made this video, so a little below the market in volatility and risk. Next is PE, price to earnings ratio, which a lot of people use to determine if a company is good value or not. Really, personally, I don't use PE for anything. Maybe I look at it over time, but that's it. If you want to know why, see my video on how price to earnings is mostly irrelevant and how it can be manipulated. The PE here is the trailing 12 months. I also have the forward PE, again, just to have the basic idea of the price to earnings over time. It's hard to say what a good PE ratio is, so compare two companies in the same market or sector and use that to differentiate, and remember to look at the PE over time. Is it higher or lower than the last 12 months, etc. Intel's PE over the last 10 years was ranging from 6.92 at the lowest, the median was 12.94, and max was 25.29. Currently, we're sitting around 15. Now, revenue and earnings, the interesting part. Here I have the last 5 years' revenue and growth. We want to see if our company grows its earnings, and for me, I need at least 12 to 15% every year. Intel was at a horrible 0.71% growth over the last 5 years, so nowhere near my 10 to 15 threshold. I would like to see 10 to 15% and preferably a lot more. Of course, if the company is in startup mode, I can accept some years with revenue growth but no earnings growth. Like with Amazon, where they use their earnings to acquire market share and customers, but they have a clear path to, let's call it total domination, then it can be accepted. Intel has always been kind of cyclical. When everything lines up, they do well, and when they miss deadlines, etc., they don't do very well. Just look at the 2022 revenue, down 20% from 2021, and earnings down 60%. Oof. And they even guide for lower sales in 2023 and maybe even 24. Maybe that will change in 25 or 26, but as of now, it doesn't look good. But wait, isn't Intel the market leader? The answer is kinda, yes, but the trend is lowering. In their big business, the data center CPU, Intel had 80% of market share in 2021. In 2022, that went down to 70%, and almost all of that was taken by AMD. And the important part is that Intel is declining while AMD is growing. Maybe the most worrying part is the fact that Amazon Web Services doubled the number of its own in-house ARM-based chip Graviton. Remember ARM? Microsoft finally uses ARM support for the developers and operating systems, and they also have their own silicon too. And of course, Apple has taken the same approach for some time. So I believe Intel will get disrupted very soon, if not already, and the ARM technology is the way forward. Operating income. Operating income shows us how much a company's revenue will eventually become profits, we hope. It's the amount of money a company makes only looking at the operational part of the company. Operating income factors in two major types of expenses: costs of goods sold and operating expenses. COGS, or cost of goods sold, are the expenses directly related to the manufacturing of those goods and/or services. It includes the administrative and general expenses prior to taxes and interest expense. Operating income doesn't include one-off items and such stuff. We would like to see an increasing amount of operating income, as this means management is generating more revenue while controlling expenses, production costs, and overhead. And again, for Intel, the numbers are horrible. -15 in operating income growth. Ugh. Net income, also called net earnings. It's operating income minus depreciation, interest, and taxes. It's useful because we see how much revenue exceeds the expenses of the company. It's also used to calculate earnings per share. Analysts often refer to this as the net income, the bottom line, since it's at the bottom line of the income statement. I use the last 5 years and average, and would like to see at least 10 to 15% average growth. Intel has almost 11%, which is not bad. And when revenue is declining, we need to look into why and how are they getting that growth. Are they playing with the numbers? Are they spending less? What's the reason? When we take a look at the 5-year trend, we can see that Intel actually has lost a lot of income over the last 3 to 4 years. And the only reason that the 5-year growth number is at almost 11% is because of the great 2018 number. In reality, Intel is losing a lot of income and will only get worse. At least, that's my idea. Intel just recorded a really bad Q1, and the outlook for the rest of 2023 is equally bad. EBITDA and growth. EBITDA is earnings before interest, taxes, depreciation, and amortization. It's a measure of profitability to net income by stripping out the non-cash depreciation and amortization expense as well as taxes and debt costs. EBITDA is not recognized under generally accepted accounting principles, also called GAAP, and some public companies report EBITDA typically excluding additional costs such as stock-based compensation, etc. And it's widely known that EBITDA overstates profitability. Charlie Munger always calls EBITDA for bullshit earnings. I use them only to see the trend over time. And Intel is showing what bad decisions look like with an EBITDA cut in half for 2022. Earnings per share and growth. That brings us to the real interesting part. Earnings per share. This is our profit divided by the outstanding shares. It's common for companies to report EPS that is adjusted for extraordinary items like share dilution and so on, and that's called diluted EPS. The higher a company's EPS is, the more profitable it is, and we can use the EPS to calculate a company's future price. Here I use an EPS and growth calculation, but more on that later. Intel has declined EPS for the last couple of years, and in 2023, EPS is projected to be negative. Only because of the great 2018 numbers, this field is green. That's why it's important to have looked at the numbers and not just looked at the value in the field showing the 5-year trend. Free cash flow and growth. Free cash flow is how much cash a company has after paying its bills for ongoing activities and growth. And remember the growth part here? Free cash flow cuts through the BS and other guesstimates in reported earnings. Regardless whether a cash outlay is counted as an expense in the calculation of income or turned into an asset on the balance sheet, free cash flow tracks the money. It shows a company's ability to pay down debt, pay dividends, buy back stock, and facilitate growth. We can also use free cash flow to calculate what a company will be worth in the future. I prefer the discounted cash flow calculation to value companies I invest in, as it's very hard for companies to cheat with their cash flow. And here we see the writing on the wall. 2018 was a great year, 2019 also okay. COVID helped a lot in 2020, but boom, 2021 was a killer, and 2022 was even bigger killer of cash flow. But wait a minute, Intel could be investing all its money, so let's quickly look at the R&D and CapEx. No, they don't line up with the drop in free cash flow, and neither does the dividend or the share buybacks. We will probably see that in the next part. Financial strength. This part focuses on the company's financial strength and how management uses cash and debt. Cash to debt, also known as cash flow to debt ratio. This ratio is the company's cash flow from operations to its total debt. This type is a kind of a coverage ratio, and it's used to determine how long it would take a company to repay its debt if it devoted all of its free cash flow to debt repayment. Cash flow is used rather than the earnings because cash flow provides a better estimate of a company's ability to pay its obligations. A good ratio would generally fall between 1 and 2. Anything above 2 is considered very strong. This indicates that the company has more than enough operational cash flow to cover its total debt. Intel is at a 0.68. Not very good. Equity to asset. The equity to asset ratio measures the amount of equity a company has in relation to its total assets. It's a very important metric that analysts use to gauge the financial health of a company. The equity to asset ratio is determined by dividing the total equity by total assets. This result, expressed as a percentage, represents the portion of the company's assets that are financed by equity. Why is that important? Well, the ratio indicates how much a company's assets have been generated by issuing equity/shares rather than taking on debt. So a business with a high equity to asset ratio is usually financially sound and relies less on debt financing. As a result, the business is better able to withstand financial shocks or bad time. Intel has an equity to asset ratio of 0.56. I would like to see at least 0.70, and the median for chip manufacturers is around 0.68. Debt to equity. Debt to equity measures how much debt the company has compared to the amount of equity it has. And we can go deeper in that using 3 other metrics called current ratio, quick ratio, and cash ratio. I'll take them just after this one. The current ratio measures the company's ability to pay short-term obligation, debt that's due within 1 year. It's called current because it uses the company's current assets to pay current liabilities. A ratio under 1 indicates that the company's debt due in 1 year or less is greater than its assets/cash or short-term assets expected to be converted to cash within a year or less. A current ratio of less than 1 may seem bad, although different situations can negatively affect the current ratio, like when a large number of invoices have to be paid, etc. Here, Intel does not look so bad, but the reason is they have a lot of long-term debt instead of short-term. The quick ratio. The quick ratio measures the company's capacity to pay the current liabilities without needing to sell any inventory or use financing. The quick ratio is considered a little bit more conservative than the current ratio, which also includes all current assets as coverage. The quick ratio is calculated by dividing a company's most liquid assets like cash, cash equivalents, marketable securities, and accounts receivables by the total current liabilities. The higher the ratio, the better a company's liquidity and financial health. The lower the ratio, the more likely the company will struggle with paying debt. The best way to use this ratio is to look at them over time and see how they perform. Are they getting better or worse? Intel is helped with its long-term debt. If you can say helped here because debt is never fun, that just means they have a longer time to come back on track. The cash ratio. This one evaluates a company's near-term liquidity. It specifically calculates the ratio of a company's total cash and cash equivalents to its current liabilities. The metric evaluates company's ability to repay its short-term debt with cash or near-cash resources. If the ratio is higher than 1, the company has more cash and cash equivalents than liabilities. Usually that's a good thing, but sometimes it can be bad. If a company is not utilizing its cash for growth or they are herding cash to pay some unknown event in the future, that's something to look out for. Intel is a little under 1 and has a small warning signal here. Debt to EBITDA. Debt to EBITDA, earnings before interest, taxes, depreciation, and amortization, is a ratio measuring the amount of income generated and available to pay down debt before covering any interest, taxes, depreciation, and amortization expenses. Debt to EBITDA measures a company's ability to pay off its debt. A high ratio could indicate a company has too much debt. So what's a high ratio? Well, this is tricky. Some industries are more capital intensive than others, so a company's debt to EBITDA ratio should only be compared to the same ratio for other companies in the same industry. The best use of debt to EBITDA is to look at it over time. If the ratio is declining, the company is paying off debt and/or growing earnings. In Intel's case, we take a peek at the competition, and AMD has a ratio of 0.52, Texas Instruments 0.94, the industry median is around 1.07, and Intel's is around 2, so not good. Interest coverage. The interest coverage ratio measures a company's ability to handle its outstanding debt, and since a company cannot grow and may not even be able to survive unless it can pay interest, well, then it's important. The ratio represents how many times the company can pay its obligation using its earnings. A good interest coverage ratio varies not only between industries, but also between companies in the same industry. A ratio of at least 2 is generally considered the minimum acceptable amount for a company that is solid, consistent revenues. I usually prefer a ratio of 3 or better. A ratio below 1 equals a company that has very big trouble meeting its current interest payments. Intel is around 471, meaning Intel can pay off its interest for 4.71 years with current earnings. It's okay, but remember, earnings are diminishing. Next up is the Piotrowski F-score. The Piotrowski F-score is named after Chicago accounting professor Joseph Piotrowski, who devised the scale according to specific aspects of a company's financial statements. It's focused on the company's accounting results in the recent years. The score consists of 9 criteria used to determine the strength of a firm's financials. For every criteria met, 1 point is awarded. Otherwise, no points. The points are then added up to determine the total value. The final score is used to determine the best value stocks, with 9 being the best and 0 being the worst. The Piotrowski score consists of 3 categories: profitability, leverage liquidity, and source of funds, and operating efficiency. Let's start with profitability. Profitability criteria are positive net income, 1 point, positive return on assets, ROA, in the current year, 1 point, positive operating cash flow in the current year, cash flow from operations being greater than net income, that's called quality of earnings. Then we switch to the leverage, liquidity, and source of fund criteria. They are lower amount of long-term debt in the current period compared to the previous year, meaning they're paying off debt. Higher current ratio this year compared to previous year means more liquidity. No new shares issued in the last year, lack of dilution. And then we get to the operating efficiency criteria. Higher gross margin compared to the previous year. Higher asset turnover ratio compared to the previous year. And this gives us a final score. If a company has a score of 8 or 9, it's pretty good. If a score is between 0 and 2, the stock is really weak. So how is Intel doing here? Well, a positive ROA, return on asset, equals 1 point. Positive CFROA is 1 point. CFROA is higher than ROA, another point, and that's it. That's it, no more. Measly 3 out of 9 points. Huh. For comparison, AMD has 5 out of 9, TSMC has 7 out of 9, so Intel is at the bottom of the barrel. Next up is the Altman Z-score. The Altman Z-score is the output of a credit strength test that gauges a company's likelihood of bankruptcy. The score is based on 5 financial ratios, which can all be calculated using the 10K filing. It uses profitability, leverage, liquidity, solvency, activity, and tries to predict whether a company has high probability of becoming insolvent.
Turning to the stock market, Animotion is up an eighth.
Yes!
After plunging 75 points this morning.
Oh, I hope plunging means up, and 75 means 200.
The firm declared super-duper bankruptcy, which is terrible news for the company's only stockholder, Homer Simpson.
Oh!
We can calculate the Altman Z-score as follows. 1.2 times A plus 1.4 times B plus 3.3 times C plus 0.6 times D plus 1.0 times E, where A is working capital, total assets, B is returned earnings divided by total assets, C is earnings before interest and tax divided by total assets, D is market value of equity divided by total liabilities, and E equals sales divided by total assets. A score below, I usually say 2, means it's likely that the company is headed for bankruptcy. Are we going below 1.8? There's a high probability of bankruptcy. And all companies with scores above 3 are not very likely to go bankrupt. Usually I don't like anything below 2. Intel's Altman Z-score at the time of making this video was 2.14, so I would call that in the gray zone. Again, remembering that everything is diminishing, earnings, revenue, everything. The Beneish M-score. The Beneish model is a mathematical model that uses the financial ratios and 8 variables to identify if a company has manipulated its earnings or not. It's usually used to uncover financial fraud. When calculated, the score describes the degree to which earnings could have been manipulated. The score was originally made by Professor Daniel Beneish of the Kelley School of Business at Indiana University, and famously, a group of business students used the method to predict Enron Corporation and their manipulating of their earnings. The basic idea is that a company may be more likely to manipulate their profits if they show deteriorating gross margins and operating expenses, and leverage is rising along with significant sales growth. The 8 variables for the Beneish model is DSRI, Days Sales in Receivable Index, GMI, Gross Margin Index, AQI, Asset Quality Index, SGI, Sales Growth Index, DEPI, Depreciation Index, SGAI, Sales and General and Administrative Expenses Index, LVGI, Leverage Index, TATA, Total Accruals to Total Assets. Once these 8 variables are calculated, they are then combined to achieve the M-score for the company. I never do this myself, I always look them up because this is just too cumbersome. An M-score of less than minus 1.78 suggests that the company is not manipulating. An M-score greater than minus 1.78 signals that the company is likely to be manipulating. Intel's score is minus 3.3, so not very likely they're manipulating anything. WACC versus ROIC. The whole point of analyzing financials is determining if the company's assets generate returns that exceed the cost of funding those assets. And the next question, once we determine those returns, will those excess returns continue? Warren Buffett often speaks of moats. His best investments was like See's Candy, Coca-Cola, American Express. They have economic moats. Those moats allow the business to raise their prices over years while expanding their profits. and they can reinvest in their business with incremental cost compared to the growing asset. To evaluate this, we use the WACC versus ROIC ratio. WACC is weighted average cost of capital. It's a blend of costs of capital across all sources like common shares, preferred shares, and debt. It's a percentage of total capital weighs the cost of capital and is then added together. WACC is a measurement of the cost of debt and equity expressed as a percentage, and it tells us how much we should expect in return for investing in that company. The WACC value is very interesting for people who want to invest. ROIC is net operating profit after tax, also called NOPAT, divided by invested capital, return on invested capital. ROIC is the amount of money a company makes above the average cost it pays for its debt and equity capital. The basic idea is that ROIC tells us how efficient is the company to generate greater returns than it costs to create those returns. So WACC versus ROIC is useful because it looks at the cost of equity and debt. It tells us how much those costs equal the rate of return we should expect. If WACC is smaller than ROIC, the company is creating value because the company is investing in value-creating projects. If WACC is higher than ROIC, the company is destroying its value because it's investing in something that returns lower than the cost of funding that project. Beware though that ROIC can be vastly different for different sectors, since companies that build stuff usually invest capital more intensively than those that require less equipment. Intel's WACC is 4.67 and ROIC is 1.87, meaning Intel's return does not match up to the cost of capital. They are destroying value right now. Now I have the simple metrics and they should only be used as a guideline over time. Price to sales. The price to sales ratio compares a company's stock price to its revenue. The ratio tells us how much equity investment from investors is needed to deliver $1 of revenue, meaning if the ratio is lower than 1, it indicates that investors are investing less than $1 for every dollar the company makes, and vice versa. Just as the PE and other simple metrics, it's only used to compare similar companies over time. AMD's price to sales is 6.10, so using this metric alone, Intel is cheap, but it still requires over $2 invested per dollar it makes. Price to book ratio. The price to book ratio, also called PB, reflects the company's equity relative to the book value of its equity. It's difficult to pinpoint a specific value that's good in a price to book ratio. Traditionally, any value under 1 is considered good, indicating that this is an undervalued stock. However, some investors may often consider stocks that have a price to book less than 3 as their benchmark. I use 2 as my benchmark. Intel is at a 1.26, but looking over the last 10 years, the lowest was 1.03, median 2.6, and the highest was 3.79. So, ratio around 1.26 is okay. EV to EBITDA. Enterprise value divided by earnings before interest, taxes, depreciation, and amortization. So, basically, enterprise value is the company's total value, and EBITDA is the company's overall financial performance. Again, remember, EBITDA is bullshit earnings. You can look at it as an advanced version of the PE, again, used over a period of time, or by comparing companies that are very similar. It's often regarded good when the EV to EBITDA is low, as this means the company is undervalued. Most investors will say a value below 10 is good. For comparison, the S&P 500 has averaged between 11 and 16 in an EV to EBITDA over the last few years. Intel is around 6.72, which is okay, especially looking over time, with 4.16 as the lowest, 6.74 as the median, and a max of 9.1. Price to earnings growth ratio, also called PEG ratio. The PEG ratio is a stock's price to earnings, PE, ratio divided by the growth rate of its earnings for a specific time. It's used to determine a stock's value while also factoring in the expected earnings growth. it's a little bit better than the simple PE ratio. Peter Lynch says if a company's PE and expected growth rate are equal, this shows a fairly valued company. When a company's PEG ratio is lower than 1, it's considered undervalued, while a stock with a PEG ratio higher than 1 is considered overvalued. In Intel's case, the earnings growth is negative and we can't calculate the true PEG ratio. I'll then look at the analyst consensus, and their consensus is that the growth will be very slow the next couple of years. So, EPS, earnings per share, one of the great ones. This is the company's profit divided by outstanding shares. This shows us how much each share earns and is a good indicator of how profitable the company is. Now, what's the difference between basic EPS and diluted EPS? Well, basic EPS is the net income divided by outstanding shares, and it's the one mostly used. It's also the simplest definition, and I like to go with the diluted one. Diluted EPS includes shares that are not currently outstanding but could become outstanding if options and other were to be exercised. This is the one I use. Intel used to have great EPS, but as you can see, it's been steadily declining. 2023 guided to be negative, and probably also 2024. My guess is it will take 3 to 5 years for Intel to rebound. Now we get to the fun stuff. This section is where we try to determine what the fair value of the company is and relate that to the amount of shares. Book value per share. Book value is the difference between the company's total assets and total liabilities, where book value reflects the total value of the company's assets that shareholders of the company would receive if the company were to be liquidated right now. Book value is often a lot lower than the company's market value. Book value divided by outstanding shares is what we call book value per share. EPS valuation. This is a calculation based on the company's current, or let's call it trailing 12 months EPS, and we project that out the next 5 or 10 years. We have an anticipated growth rate, and then we discount that back with a minimum required return. It's very hard to predict the future growth of a company, especially 10 years out. So sometimes I will use a 5-year growth rate, a 5-year horizon, and maybe be a little bit conservative on the growth rates. But seeing that Intel is definitely not growing the same amount as it used to, I have to make an educated guess. I use last year's EPS, even though I'm fairly confident that next year's EPS will be 0 or even negative. I use a growth rate of 6% for the first 5 years and 3% for the next 5 years. That is very, very low, but rather be an error on the right side. Then I discount that back to today. The discount factor, which is my expected rate of return, in this case 12%, as I'm used to getting 12% in my other investments. This will give us a fair value of the stock of $27.27. Remember, we haven't used any margin of safety, so we should lower that price with our margin of safety. Discounted cash flow valuation. This is kind of the same as the EPS, only using cash flow. We take the trailing 12 months cash flow per share, and again, growing the same percentages, 6%, 3%, discount that back with our required return, 12% again. However, the problem here is Intel didn't have any free cash flow. So to get any number we can use, we need to go back in time to the 2021 free cash flow, which we all know is not going to be the same next year. But hey, this is just to show the example and how the evaluation method works. And it could also be that Intel all of a sudden becomes what a so-called turnaround and starts having a lot of free cash flow again in a few years. So I'm going to stay with that calculation as of now. It's still only a part of the complete valuation, so let's go. Next up is the Graham number. The Graham number, or Benjamin Graham's number, measures a stock fundamental value by taking into account the company's earnings per share and the book value per share. The Graham number is the price range that a very defensive investor should pay for the stock. Basically, it represents that the current price should not be more than 15 times average earnings of the past 3 years, and current price should not be more than 1.5 times the book value. So Benjamin Graham made the formula 22.5 times EPS times book value per share squared. The 22.5 represents the ideal PE ratio of 15 and price to book of 1.5, giving us the number 22.5. So for Intel of the end of 2022, that's giving us a value of $26.89 per share. Peter Lynch fair value. Ooh, I'm a great fan of Peter Lynch and his way of viewing the investment world. And he has very simple approaches to value. Peter Lynch fair value is usually used for growing companies and with at least 10 to 20% growth. The growth rate I use is the average growth rate for EBITDA per share over the past 5 years. If the 5-year growth rate is smaller than 5% a year, we do not calculate the value. The calculation is as follows: PEG ratio times 5-year EBITDA growth rate times EPS. EBITDA growth is subject to less manipulations than net earnings per share. For Intel, we really can't calculate it as the EBITDA growth for 5 years is negative again. So for the sake of the example, I exclude the value from the calculation this time. With those metrics, we get an average share price of $26.82. I'm using a margin of safety of 10%, so my buy price is around $24. And looking at the graph, we can see that the price has reached that level, and the latest time was back in February, so it's not an impossible price target, especially not going in a recession. And I will also believe it will come down again maybe in Q2, Q3, so let's just wait and see. But I'm still not buying Intel. I simply don't like the fact that the most of the big players are focusing on ARM and mobile devices, all except Intel. They don't seem to realize that trend is going. As I said in the last video, mobile devices are the future, and Intel is asleep at the wheel. I'm just gonna move quickly to the right side of my valuation sheet. The fields that we just covered are my calculation to assess fair value of a stock, and the next one are just the basic financials and their 5-year growth. Gross margin. Gross margin, as we discussed earlier, is a company's gross profit compared to its revenues as a percentage. We would like to see healthy gross margins and preferably rising every year, and we don't need to see them declining. Gross margin is okay, but not the good old 65% Intel used to have, and it's been declining the last 5 years. Operating margin. A company's operating margin, sometimes referred to as a return on sales, ROS, is a good indicator how well the company is being managed and how efficient it generates profits. It measures the company's overall profitability from operations. It is the ratio of operating profits to revenues. The operating margin shows us how much earnings from operations is generated from every $1 in sales after accounting for the direct costs involved in those revenues. Net margin or net profit margin. Profit margin measures how much net income is generated as a percentage of revenues received. Net profit margin helps us to assess if a company is generating enough profit from its sales and whether operating costs or overhead are under control. ROE, return on equity. ROE is the company's net income divided by its shareholder equity. It tells us how efficiently the company generates profit. The higher the ROE, the better the company is in turning equity into profit. Whether ROE is good or bad depends on what is normal among the peers in the company in the same sector, the same types of company. For example, utilities have many assets and a lot of debt on the balance sheet compared to a relatively small amount of income. A normal ROE in the utility sector could be 10% or less. A technology or a retail firm with a smaller balance sheet accounts relative to net income may have normal ROE levels at 18% or more. Well, a good shortcut is to consider a return on equity near the long-term average of the S&P 500. As of Q4 2022, that's 13.29%. So, as an acceptable ratio and anything less than 10% is bad, Intel has an ROE of 8%. ROA, return on assets. Return on assets indicate a company's profitability in relation to its total assets. ROA is used to determine whether a company uses its assets efficiently to generate a profit. You can calculate ROA by dividing its net income by total assets. It's always best to compare the ROA of companies in the same industry because they'll share the same asset base. ROA factors in a company's debt while return on equity does not. The more leverage and debt a company takes on, the higher the ROE will be relative to the ROA. Intel's is almost twice as high. In this example, Intel returns 4.59 cents for every dollar invested. ROA over 5% is generally considered good and over 20% excellent.
Excellent.
However, ROAs should always be compared in the same sector. Like a software company has far fewer assets on the balance sheet than a car company. As a result, the software company assets will be understated and its ROA may get a boost. ROI, return on investment. Return on investment is calculated by dividing the profit earned by the cost of that investment. For instance, an investment with a profit of $100 and a cost of $100 will have an ROI of 100%. It's a fast and simple way to gauge an investment. So, what qualifies as good ROI? That depends on a lot of factors, such as the risk tolerance of the investor and the time required for the investment to generate that return. Historically, the average ROI for the S&P 500 has been around 10% per year. As the S&P 500 is usually the benchmark, I like to see at least 12%. If you don't believe that is possible, then see my video on how to get those returns. I'll have a link in the description. ROIC, return on invested capital. ROIC is how well a company allocates its capital to get profit. Seen in another way, ROIC is the amount of money a company makes that is above the average cost it pays for debt and equity. To calculate return on invested capital, you divide net operating profit after tax, no PAT, by invested capital. As we covered under the WACC, a company is creating value if ROIC is higher than its weighted average cost of capital. Intel's ROIC is 1.87 and WACC is 4.87, so Intel is basically destroying value right now. ROC Joel Greenblatt, return on capital. Joel Greenblatt introduced something he called the magic formula back in 2005 in his book, The Little Book That Beats the Market. I highly recommend you reading this. This version of the return on capital is used to measure the rate of return a business is making on its total capital. It's calculated as EBIT divided by net working capital plus net fixed assets. A high double-digit figure often means that the company has a defensible edge versus its competitions, i.e. strong brand, unique product, a moat as we call it. To illustrate that point, Coca-Cola has a value of 179%, and Intel has 11.29. Return on capital employed, ROCE, measures a company profitability in terms of all its capital. It's similar to ROE, but unlike return on equity, which only analyzes profitability related to a company's equity, ROCE considers debt and equity too. This helps neutralize financial performance for companies with significant debt. Higher ratios tend to indicate that companies are profitable. It's always good to compare the ROCE for companies in the same industry, as it will vary a lot over different sectors. And again, it's a good idea to use it over time. Intel had 16% ROCE and has been trending down to the current 5.67. Eesh. The semiconductor industry has an average of 15%. So not good. The last part of my valuation sheet is just for dividends. I'm not really a dividend investor per se, but I do have a portfolio focused on dividends. I actually plan to have that portfolio grow and to sustain my lifestyle with dividends alone. so I don't need to sell any of my great growth companies before I really want to. Think about it. If you were retiring during a recession and all of your stocks went down with 30 or 50%, you would have to sell at the worst possible moment, destroying your nest egg just because of a small recession. Currently, I'm not even close, but I have some nice dividend payers, and it will get more. Eventually, the goal will be that I can live off the dividends and the extra from my pension plans, and have a very comfortable life without selling anything else. Dividend yield. The dividend yield is the amount of money a company pays shareholders for owning a share of its stock divided by its current stock price. It's important to remember that higher dividend yields do not always indicate attractive investments, because the dividend yield of a stock may be elevated because the stock price has been declining, and/or some companies just pay out more just to get investors. I don't have a specific number here, but I look at the company, the risk, the stability, though the minimum I can accept from an old company like Intel would be around 4%, and Intel is at 4.71, so okay with that. But knowing that Intel has slashed its dividend and will probably not get back to 2022 levels in some years, this is a huge red flag, as I only see Intel as a dividend stock, not a growth stock or anything else. Dividend yield versus dividend payout ratio. When you compare dividend yields, it's important to note that the dividend yield tells you what simple rate of return is in form of cash dividends to shareholders. However, the dividend payout ratio represents how much of a company's net earnings are paid out as dividends. While the dividend is more commonly used to determine if it's a good company or not, actually the payout ratio should be a better indicator of a company's ability to distribute dividends consistently in the future. The dividend payout ratio is highly connected to the company's cash flow. Some companies pay out all their earnings to shareholders, while some only pay a portion. Take REITs, for example. They are obligated to pay out 90%. A high payout ratio could imply that a company has moved past the growth stage and share prices are unlikely to appreciate rapidly. The payout ratio is also useful for assessing the continued dividends, as companies are very reluctant to cut dividends, since this will hurt the stock price. My threshold is around 70%, and Intel is just a bit above that. Dividends are not the only way companies can return value to shareholders. They can also buy back shares. This forces up stock price, and with less shares in circulation, the shares the investors hold are worth more. So, what's the verdict? Well, if it isn't obvious yet, the verdict for me is no way, Jose. I am not going to buy Intel stock, and I don't even think I would buy below $24. Even great companies can end up going bankrupt, especially when they spend cash like crazy and keep flip-flopping and don't really have a firm strategy or a clear path to profitability. I would much rather invest in Nvidia, AMD, or one of the competitors. Maybe I should look into Nvidia next. Well, leave a comment on which companies I should run through the valuation method, and I'll consider it. If enough people like the video and write the ticker in the comments, I will look into it. Quid pro quo.
Quid pro quo. I tell you things, you tell me things.
If you got any value from this video, please hit the like button and consider subscribing so you don't miss out on my future valuations. Remember, the best investment you can do is in you. The more you learn, the more you earn. Bye.
I have a dream, that's all I need. I'll make it happen with some work and belief. Know what I want, so I'll take it on. I'll make mistakes, but mistakes make you strong. Let's break it down for a minute. I want the crown, I'm gon' get it. You hear me loud, man, I'm winning. Yeah, Charlie Sheen will be grinning. These ladies know that I'm sinning, and this is just the beginning. I'm closing in the ninth inning. There ain't no point in resisting.